joining us is Frederic Neumann. He's HSBC's co-head of Asian Economic Research. What actually are these markets pricing in?
They're probably pricing in a soft landing of some sort, which is perhaps a bit too pessimistic at this stage, we feel, because the stimulus is just being
You're talking about China
out.
here, aren't you?
China, and probably also across Asia. In China, perhaps the market is being too bearish overall. We saw this big sell-off late last year. The market is disappointed for several years now. And this year might actually be the year when it turns around.
Frederick, when you look at the inflation numbers that we had today, I mean, okay, pretty much bang in line with the economists' thinking. What does it actually mean, though, for policymakers to give them more tools at their disposal to do something about growth? Should we actually see a more marked slowdown?
Well, we actually think they need to do more. So this number today was reassuring, was in line with consensus, but at least we know inflation is not heading up. And we think that the Chinese authorities will cut the RRR requirement.
Does that make a difference, actually, a big difference, cutting the RRR, the reserve ratio requirement?
It does, because you have to free up the banking system to be able to lend more. We saw a big jump in lending in December, for example. And one interesting aspect here is that as European banks pull out of Asia, local financial systems, including in China, have actually to raise their lending capacity just to replace that. And
well, have they been doing it, though?
Well, they have, according to Chinese lending data in December. And we think that will actually continue to pick up this year. So total new loans may come in at some 8 to 8.5 trillion this year, for example, higher than the 7.4 RMB than 7.4 last year. But I think also that the bigger stimulus this time around in China will be on the fiscal side. It's not just going to be monetary; it's going to be fiscal as well.
Actually cutting rates here? I mean, the actual interest rate. Will that happen?
Probably marginally. We think in the second quarter they'll probably chop rates as well. But remember that they can't do it too aggressively because they want to offer savers some return. Because if you cut rates,
negative real interest rates at the moment if you keep your money in a deposit, don't you?
You do, yes, and the risk is there. Then you may decide to buy as well property, and that's something that the Chinese will try to avoid at any cost.
Reading your research, you're saying that you don't expect an interest rate cut until we see CPI below 3% there. Now, is that a realistic proposition?
Well, we're approaching that very quickly, actually. Today's number, 4.1%. You might think it's still a long ways from 3%, but the next few months you'll see inflation drop quite rapidly on base effects alone. It doesn't mean that inflationary pressures are absent in the Chinese economy, but it does give enough room for Chinese policymakers to move.
And what does it all mean for growth?
8.6%. That's slightly lower than last year, but if you look at the contours of this year, first quarter very weak indeed. We could see growth around 6.5%, and then it accelerates throughout this year as the stimulus gains traction.
What is Tim Geithner up to on this visit, really?
Well, he has two pieces on his agenda. One is to convince the Chinese not to buy too much oil from Iran, and the other one is to open their trade and to appreciate the renminbi. And I'm not sure he's going to get very far in all those fronts.
Well, I mean, why even make that public? Because you know he's going to get nothing back and no positive response on that, surely. So is it about just thawing relations a bit more?
It's probably more about the U.S. political cycle with the presidential election year. The U.S. administration has to be seen to be doing something, to be protecting the American workers. That's what it's heading to Beijing and making noise about it. But the truth is that the Chinese are probably in a fairly strong bargaining position right now.
Well, are the Japanese, because we've had him in Tokyo this morning talking about the U.S. economy strengthening and saying that Japan and the U.S. will be doing more to try and get the global economy going.
Well, the U.S. is indeed strengthening, is contributing to global growth. I'm not sure that Japan is really in a position to do much to lift global growth at this point. The key here, I think, for Geithner behind the scenes will be Iran. We know that China is not going to move rapidly on the currency. It's really all about Iran.
Well, some have even been saying that this year could actually see the RMB actually depreciate against the dollar.
If the pressure from exporters becomes extraordinary in China, then perhaps there might be marginal depreciation. We think in general it will be volatile. It probably won't appreciate aggressively. You might see a few weeks of actually weakening. On the whole, the strengthening trend though should persist.
But overall, I mean, the dollar is likely to weaken, isn't it? That's something that the U.S. has been really trying to do and trying to push it low so it can actually balance its economy, get more exports, make it more competitive.
Yeah, and the Americans...
And the Euro one, they would like to do the same thing, but they're having a few problems with
exactly, and that raises in again the pressure on the bilateral exchange rate with China, because as the Euro weakens, it harms the U.S., and they want to pass on the buck to China, and that's a very difficult thing to do.
We talked about China, we talked about the inflation figure earlier on, Frederic. I want to just talk a little bit about India for a change. I mean, you are a fan of, in terms of the bad news is out there and the only way is up now, right?
Well, we're somewhat bullish on India, actually. There's a lot of negativity out there, but if you look at the currency, it has sold off quite a bit. I think that washed out. In terms of policy, they can really only surprise on the upside.
Hang on a second. Inflation 10%, interest rates at 8.5%. That's really hurting the corporate side of things, and we could be seeing quite a lot of weakness there, still spreading and actually poisoning the economy further.
But it's peaking. That's the key. So inflation is likely to come down to below 8% in the next reading. We'll probably see the RBI cutting rates in the second quarter, perhaps as early as the second quarter. So that is generally encouraging for markets, and markets anticipate recoveries, right? You buy at the bottom.
You see a lot of this more encouraging data, and I'm wondering, which BRIC nation do you think is currently the most volatile?
That's a good question. I think I would always point to Russia being the most volatile inherently, but we saw, for example, the currency, India being last year, certainly a standout in terms of volatility there. But that is washed out in a lot of that news.
You think so, anyway, yeah, for the time being.
You've got this perennial policy uncertainty in India, or perhaps you can count on the fact that if they enact what seems to be a forward-looking policy, the opposition will strike it down. I mean, they can't seem to move the needle on some of these key issues, as we've seen with the retailing laws recently.
That's right, and that's been a key concern for investors for some time now. But India has never had the most smooth policy process, I think, in the region. And at this stage, they can really only surprise on the upside. If they've passed a few things in the coming weeks, and we just saw the single brand retail law being passed, for example.
Again, it doesn't go far enough, though, does it? I mean, it should be, because it could actually sort out some of the infrastructure bottlenecks that India does have if we've got these multi-brands like Carrefour, like the Walmarts of this world, the Tesco's, etc., etc. It could actually be a force for good rather than one which is pointed at as being, well, one which is imperialism, etc., you know, what the opposition BJP's been saying.
It would be good. I mean, we want all these reforms, and ideally we want them today, not tomorrow. But within the Indian political context, it's just too early to expect these very quick breakthroughs, and we probably have to wait a little bit. But I think in terms of overall growth, we're probably going to see 7.5% this year, which is not too bad by any standard.
Well, staying on Mia's question about which nation really in BRIC is the most volatile, China, and if you look at how the GDP is composed, do you think the biggest risk this year, do you think it's external or is it internal? By external, of course, I mean the weakness we're seeing in demand for their exports, and internal, we have a lot of moving parts. Obviously, there you have property, you have non-performing loans in banks. And I was wondering which one, if you had to pick one, which would it be?
It'd probably be domestic. The contribution of exports to GDP growth is actually zero, and has been zero for the last couple of years. But the big swing factor in China is investment, and here the private construction activity for housing, for example, that is still a key risk. The government will make up for that through public housing construction, but clearly we don't know the scale of the slowdown in private construction activity for apartments, commercial buildings, and so forth. And that is, I think, the key swing factor if you look at China.
So what's I mean, just what's the big fuss about then, about slowing exports in China if it doesn't really matter? I mean, as you mentioned,
it's a political issue more than anything, because it's very concentrated in the southern coastal areas. For example, you have a lot of factories employing millions of people, and it doesn't necessarily contribute to the overall economy, which is increasingly becoming closed, actually. On all the data, we see China turning inwards, but it does play a political role. If companies are going under, they're feeling competitive pressure, and that plays itself out on the exchange rate as well, and that's something that Geithner is battling in Beijing right now.
Will we continue to see pro-consumption policies roll out of Beijing going into Q1, Q2?
Yeah, they will have to get more aggressive, clearly. So in the run-up to the Chinese New Year, probably RR cuts, but then right after, more fiscal stimulus, a lot of more reform to really bring demand back up. The risk is with China's New Year, in fact, is that you have this run-up of activity, retail sales are strong, people travel, some 3 billion journeys being, undertaken.
Louis Vuitton apparently is the biggest place for gifts for Chinese New Year. I had no idea.
It's amazing, isn't it? It's just, and the rush you get people returning back to their home villages, etc.
It's the biggest migration.
I guess the big question there is how aggressive is too aggressive, right, at the end of the day? What does that mean?
That's true. We've got to leave things there, though, guys. Thanks a lot very much, Fred Neumann there from HSBC.